webinar, the continuation of the Maximum Performance webinar series. My name is Erik Janeczko. I'm the head coach and CEO of the Maximum Acceleration Coaching Program and Company. And today's is a continuation of a webinar we did at the end of May that talked a little bit about mastering first impressions. And as some of you experienced, and those of you listening on audio recording may experience this better than others who are live on today's program, there was a kind of a fortunate but unfortunate circumstances with the start of today's program where there was actually some confusion and we failed to make a very strong first impression. There was a glitch in the system here with the GoToWebinar platform where the time zone got converted improperly, and some of you logged on an hour ago thinking that this program was going to start at 10 a.m. Central instead of 11 Central. And, you know, here's the reality. We all know the truth of the fact of the matter is we only get one chance to make a first impression. We never get a second. So now I've got 48 minutes to come back and overcome the pain, the anxiety, the confusion, and the lack of credibility that came from the fact that our system glitch made it look like we don't know what we're doing. In other words, we've created a bad first impression. And so now what we want to talk about in today's program is how you as an originator and as a mortgage advisor can educate your clients, provide them massive value at first point of contact, and create a value experience that separates you from the flock. You know, in today's competitive environment, we've got to determine what makes us unique. We've got to figure out how to stand out. How do we separate ourselves from the flock of other originators out there that, especially with the market moves of the last couple of days, have really created an overwhelming firestorm of, you know, complexity and challenge in the market. I mean, think about it. How many mortgage loan officers that worked in a refinance-focused market or focused their business or worked in a call center type origination shop have an empty pipeline? I mean, we've lost something over 350 basis points in pricing in the last 4 business days. You know, market rates have tanked, rates have shot up dramatically, and agents are now, you know, real estate agents, business development partners, and loan officers are scrambling to find purchase opportunities, meaning there's tons more competition hitting the agents. Agents are getting 4, 5, 6 calls a day from loan officers they've never heard of with companies they've never thought existed. And all of a sudden, we're trying to compete in that market as well. So one of the things that we're going to focus on today is how to create a wow experience, an overwhelmingly more valuable experience. Because what's in it for them is the ultimate when it comes to mastering first impressions and creating separation such that you make the competition irrelevant. So that's what we're going to drill down into part 2 of today, which is once you've captured that initial energy and created that initial excitement with the borrower, how do you follow through on delivering the high expectations you set with that first call? Now, those of you joining us for the first time today, if you would like to be able to access the previous version, the part 1 of today's program, you're welcome to go to our YouTube channel and pick that up off of the MX, it's on the Janeczko YouTube channel. You can look us up. We'll also be forwarding out, when we follow out the forward-up messaging for today's program, you'll also be able to catch part 1 of the program as well. But at the end of the day, think about this word value for just a minute. How would you define it? What would you talk about, and how would you create or explain value? In fact, many of you are welcome to go ahead and hit me up in the Q&A and let me know your definition of it. By the way, as we go through today's program, one other housekeeping item, we are going to be doing interactive Q&A a little bit later in the program, and even if we don't have time to get to any of your questions, make sure that as you think of questions throughout today's program, make sure that you post those questions in the Q&A. We will be tracking those questions and following up with you. Our coaching team will be reaching out to you to make sure that you get your questions answered. So as we start thinking about what is value and how do you define value, and how do our customers define value, first thing we have to think about is, you know, think about it as a mathematical equation for just a second. If we were to try and express it this way, the best way I found to explain that is to think about value equals benefit minus cost. What they get minus what they pay for it determines whether they experience value or not, whether that value is valuable enough that they do the business with you versus somebody else, and whether they buy. If they don't experience a high enough benefit, for example, if this equation is out of balance, if the benefit does not exceed the cost and they end up with a negative number when they solve for value, they don't buy. They go to somebody else. They shop with the competition, and they come back to us multiple times asking for a discount, or doing the bidding war type situation between us and a competitor, right? So if this equation is out of balance, how do we rebalance it? Well, there's really only two ways. We can raise our benefit, or we can lower our cost. And that became even more difficult in a post-Dodd-Frank world, because we have to set our pricing for the entire month, and depending on your company's interpretation of those LO comp rules, you may even have to set it on a quarterly basis. It may be even set for you as an originator, because the company, with the lack of guidance from the CFPB, and with the company's maybe has a little bit more conservative interpretation of this, where all loan officers have to be paid the exact same compensation. And so, it's determined for us. We may not be able to lower our cost. So how do we compete in an environment where the price is set for us? We have little or no control over the cost. Then we have to focus on benefit, right? So how do we create massive benefit, significantly more valuable for our customers so that they buy through us? Now, in the previous event, I shared an analogy that compared, let's say I've got $10,000 that I want to invest in a stock purchase. Okay, I decide I'm going to buy 100 shares of a company that's $100 a share per se. Now, I've got two options for how I can place that investment. I can go with the lowest price, or I can go with one that has a more valuable service. Now, the reality is, I've got the same $10,000 that I want to invest. I can go to E-Trade, open a stock trade account, and pay $10 a trade to buy that 100 shares of that company. The only problem is that I'm totally on my own risk and my own knowledge about whether to decide whether company A or company B is a better purchase in today's market. So the other option is I can go to a full-service brokerage firm like a Merrill Lynch or something like that. I can rely upon that mortgage advisor or that investment advisor's experience and knowledge and credibility. I can even rely upon the research department that their full-time job is to evaluate the financial performance of companies and give me better advice as to whether it's the right purchase or not. And the reality is, if I go in and make that investment, if I buy that $100 shares through Merrill Lynch, I'm likely to pay anywhere from $120 to $150 for that same exact trade, that same exact purchase of that same 100 shares in that A company. So why would I spend 12 to 15 times more for the same investment as opposed to going through the lowest price? Well, the obvious answer is because I'm hoping to get a better trade. I'm hoping to get better advice as to what company to put that money into, and therefore likely make a better overall investment decision. But here's the problem. That's just on one transaction. So yeah, it may make sense, but how many more times am I going to continue to pay 12 to 15 times more for the same transaction? Once I start to get a little handle on it, once I study it and learn it a little bit better, maybe I start to develop a little more confidence, and over time I start moving more and more away from the one transaction at a time. Now think about how that applies as an originator. In a highly competitive market where customers are desperate, they're trying to maximize their purchase opportunities and their pre-approval so that they can be competitive in a bidding war type situation for properties. If a competitor is a quarter or a 3/8 of a point lower on note rate, or they're a couple $1,000s cheaper in closing costs, how much better can I be and still win that deal if I'm still just competing toe-to-toe on a one transaction basis? Now, one of the things that I've been challenged by over the last couple of weeks is trying to find a better way of articulating how we shift from a vendor type value to an advisor type value. And what do I really mean by becoming a true advisor to our clients? Well, one of the ways that I thought about this, and maybe this is the best way, you guys tell me whether this resonates with you or not. Imagine if I went to this Merrill Lynch advisor, and okay, he's 12 to 15 times more expensive for the same trade. And, he says, but, I really don't think you should buy company A. I think you should buy company B. Have I experienced enough value that I won't just go back to E-Trade and buy company B through E-Trade for $150 cheaper for that one trade? How does the guy at Merrill Lynch become so overwhelmingly valuable to me that I stick with him long term? And I no longer look at what I could invest through E-Trade. Well, the transition has to be moving from transactional, one deal at a time, to long-term relationship and advisory. So think about, imagine if I go to make that investment and the advisor from Merrill Lynch says, whoa, 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 slow down, buddy. Hold on. Let's take a look at whether $10,000 into one stock in one company is the right decision for you at this time. Let me look at your long-term financial picture, and let's see if this is a good fit for you, Mr. Customer. And that advisor says to me, here's the problem, Eric. You have $10,000, and that's it. You don't have any other cash reserves. You have no savings for an emergency. You've got, a handful of maxed-out credit cards. I don't think buying one stock is the right move for you at this time in your growth. I think it's going to hurt you more than it's going to help you right now. I mean, imagine, let's say, later this summer, your air conditioning unit goes out, and it's going to cost you $6,000 or $7,000 to replace it. You're going to have to potentially liquidate that stock at a loss. Let's say the stock market's dipped a little bit, and we've lost $15 or $20 per share on that company, and all of a sudden you're liquidating that $10,000 investment for an $8,000, so you suffer a $2,000 loss. I think, Eric, you'd be better off to put that money into reserves, into a well-diversified, safe money market or even potentially mutual fund, or a portion of it in a mutual fund, where you've still got some reserves, you've got some protection against potential temporary losses. And then as we build up your savings a little bit more after helping you eliminate some of that debt you're carrying, then we can start looking at, once you have a little more cushion and you can afford the risk of being able to buy a stock and hold it long term to pick up the net gain. Now, all of a sudden, that Merrill Lynch advisor is so much more valuable to me that the 15-time cost difference on any one individual transaction, the couple $100 more per trade I'm going to spend, is worth the advice and guidance of not making a stupid move that's going to cost me thousands. And that's where we translate to that advisory-based value proposition. So what I want to share with you guys over the next 20 or so minutes is how we can do that in one particular core opportunity. When you meet with your buyers for the first time, when you first talk to them, is what we kind of talked about in the first part of this program. How do we position ourselves as the true advisor? How do we separate ourselves from the competition and create a wow first impression that kind of stops the shopping process and gets them to participate and engage with us? Now, when we're at the table, we've gathered all their basic loan pre-approval information, and we're sitting down to talk about what loan options are available to them. I don't necessarily mean this has to be face-to-face. This can be done over a webinar meeting or a screen sharing or even over the phone if you had to. I prefer to have a visual element to this, but how do we get the customer to understand what's really at the heart of their issues and what's most important to them about their financial growth? And I use the analogy of the artichoke here. I mean, this was my favorite food as a kid growing up when I, had done well or gotten good grades for the year, and my mom wanted to treat me with a special dinner. I always asked for artichokes. And The problem with artichokes is, though, that you start with them and they're steamed and they've got these little prickly thorns on them, and you peel off those outer layer of leaves, you get just a tiny little morsel of meat, and you got to scrape it off with your teeth, which wasn't very fun when I had braces as a teenager. Anyway, but as you go deeper and deeper into the artichoke, the leaves get thinner and thinner, and there's less and less meat on them, and then you get to this purpley stuff that has no real value to it at all. And then even worse than that, you get to this hairy, fuzzy choke that if you don't get it scraped off just right, it completely ruins the best part of the artichoke, which is the actual heart. But once you get to that heart, that's the best tasting meat of the entire flower. And that's where, that's what they put in your salads and charge you $100 a salad for at the fancy restaurants, and that kind of stuff. So what we need to do is figure out how to get all the way through the layers of confusion and chaos and all the distractions and myths that people often approach the process of setting up a mortgage with, to really drill down on what's really ultimately most important to them, and that's their long-term financial growth strategy. One of my clients yesterday in our one-on-one coaching program and I were talking about all the different one-liners that we can use, all the different ways of presenting and overcoming value. So we get into conversations with clients often, and they start going, well, yeah, but I just, what's the rate? I need the rate. What's the rate? Well, at the end of the day, Mr. Customer, the rate is an element, one of about 23 independent factors that have to be considered when setting up a profitable mortgage. And the reality is, Mr. Customer, the best rate in the world on the wrong program is likely going to cost you a lot more than the right program at a competitive price. And that's why we take a step back and look at the longer-term picture with our clients to be able to help you set up the best possible mortgage. Now, part of the reason we talk about that is, guys, think about this. In the mortgage, one of the most important financial decisions that customers will ever make. And why is that? Is it not because the fact of the matter is, for most families, it's going to eat up the biggest chunk of their paycheck for as long as they have that mortgage? And secondly, it's the number one way they control what will likely become their biggest asset, which is their home. But how often do customers make that decision in such an isolated situation that they completely forget about how that decision is going to impact their ability to do anything else financially, such as saving for their own retirement, or maximizing their tax advantages, or caring for their family long term, or leaving a legacy to their children through any kind of estate transfer or estate planning. And all of these other issues intersect. And the cool thing about being in mortgage is we see the biggest, most complete picture of what's really going on with that family financially, of pretty much any other major profession in the financial service industry, short of the true financial planner who do take a very comprehensive look at that buyer's financial situation. So when they come to us and they start talking about what they want to accomplish financially, and we start thinking about, Mr. Customer, at the end of the day, our job is to take a step back and look at the bigger, longer-term picture so that we can help you make smart choices, because we can't afford to apply short-term thinking to what is ultimately a long-term impact decision. So when we get to the consultation appointment and we've sat down and we're talking to those clients, there's basically three primary phases that we teach our coaching clients how to use effectively, so in the most efficient manner we can create the most significant value for our clients, create that overwhelmingly powerful experience to where we're creating massive value for the clients and the competition becomes irrelevant, to the point where even if somebody was beating us out by as much as 1/4 to 3/8 of a point in note rate, or a couple $1,000s in closing costs, we're able to still win that client because we've helped them realize that the value of our advice and guidance is worth 15 to 20 times what they could get that transaction through by running down the street to the next cheapest bidder. So the three phases of the consultation we're going to talk a little bit about today are educate, consult, and engage. And the three primary phases of what we talk to buyers about in that consultation appointment. Now, as we do this with our coaching clients and as we help them get up to speed with it, we provide them with a lot of tools and resources that will help accelerate this. And one of the tools that we help them with is we provide them a PowerPoint template to start from. And then the slides are developed very simply because they're designed to be able to allow our clients very quickly and easily to be able to put their logo on it and to make the adjustments to how they want to use this visual presentation. At the end of the day, the reason we call it the 6 Steps to Financial Freedom PowerPoint or presentation, though, is because at the end of the day, don't we all pretty much have the same financial goals? I mean, at some point, we all want to get to a point where we can stop trading hours for dollars and actually have some level of lifestyle in retirement, right? But how often is it that we end up making decisions in our 20s or 30s or 40s that end up costing us retirement money in our 60s or 70s? I mean, look at the baby boomers as a perfect example, and look at the popularity of a reverse mortgage. You know, how many people are working second careers or third careers or fourth careers and still having to work a full-time job in their 70s because they don't have enough income to live on from Social Security or the meager savings that they've developed? Or maybe they hit some financial emergencies along their later years in life that wiped out their retirement. Now they're having to do things a little bit differently. But they've so aggressively prepaid their mortgage by following conventional wisdom that they get to 65 realizing they can't retire because all their equity is tied up in the property. So they have to go the route of a reverse mortgage to get that equity back so that they have something to live on. Now, so some of the things that we talk about is thinking about how this all impacts. So one of the things that our clients share with their customers at point of sale when doing this consultation is we talk about really what are the 5 drivers of financial independence? What are the things, the strategies, the elements of your personal life that have the biggest impact on your ability to achieve those long-term goals, if at all? So one of the first things we talk about is that it's all about dollar allocation. You only have so many dollars coming in and going out every month. How you use those dollars is a key to whether you do or do not obtain your long-term financial goals. There's also an element of planning that goes into that. You know, are we reactive in how we spend money, or are we proactive? Are we living off a delayed gratification budget so that we are in control and we have the greatest level of control of what's happening with that family and with our own financial growth? Second thing is we've got to try and understand and follow a proven plan that covers all of the dollars coming in and going out of the household. Not only the future spending decisions, the debt commitments that we're making now, but our day-to-day, what we spend, you know, do we go for a coffee or a Frappuccino? Do we go for, you know, do we get a Coke with and the French fries with the McDonald's meal or not? Or, you know, what do we do with our discretionary spending? That's kind of the current spending habits. And then what do we do about the previous spending decisions, dollar allocation decisions that were made in the past? Third is we need to recognize and understand that compounding interest works very, very differently than amortizing interest. Now, most of our customers know that, right? I mean, if you ask your customer, how do compounding interest and amortizing interest differ? They could probably tell you, if they thought about it for a little bit, that compounding interest, dollar for dollar, month by month, grows. Amortizing interest, the cost of the interest on a loan, dollar for dollar, month by month, shrinks. So they go in completely opposite directions. But how often do our customers think about that when deciding how to set up a mortgage? Fourthly, we need to get them to realize that timing is everything. That's where we get into that past, present, and future allocation decisions. And then the fifth key concept is what is a perceived versus real asset? What are the tests of a good asset? Well, you know, a lot of the science and research from this is through the research and development work of popular authors like Rick Edelman, who's written numerous books on financial growth strategies and how to leverage. One of his foundational books was a book called The Truth About Money. Basically what Rick Edelman is, he's the #1 financial planner in the United States currently, or at least traded first and second frequently. What he did is he went out and studied over about a 15-year period what all of his true wealth clients who truly had passive income that was more than adequate to meet their lifestyle needs. You know, for some people that's $60,000 a year, for some people that's $600,000 a year. But by working their careers and by following the right strategies, they had all built a consistent level of passive income that met their minimum lifestyle needs. And that's kind of how we define financial independence. Well, one of the things he found out is that far too often people make the mistake of buying a home in a vacuum or making mortgage decisions without any consideration at all to how that decision impacts that family's ability to achieve any of their other financial goals. So when we sit down with our clients, with our mortgage customers, and when our coaching clients sit down with their mortgage customers, we talk about a model called the 6 steps to financial freedom. We introduce them to the concepts of how to establish a cash budget, that it's all about controlled spending, and that you need to be saving, spending less than you make every month so that you have leftover that you can save for the future. Second step is we need to build a cash cushion, which is to build that emergency fund. Now, a lot of people would think, let's get out of debt first. Well, the reality is we have to break the power that debt has over us first, because most people's emergency plan is credit cards. You know, if the refrigerator goes out, or if the furnace breaks, or if the car needs some major repairs, they put it on a credit card, which means now that debt is costing them 6 to 8 times more than it should, because it's on a high-interest revolving debt as opposed to on a structured debt. Third thing is that we need to pay off so the first thing is building enough of a cash cushion for those customers that they don't have to rely on credit cards to cover the unexpected emergency expenses that seem to pop up all the time, right? So the third element then is how do we get them out of debt more quickly? You know, how do we get them to structure which cards they pay off first and which ones they leave alone? Maybe there's some element of in a finance transaction we're talking to them about doing a debt consolidation and paying off the highest interest cost credit cards. I mean, think about it. So you had one credit card that was costing you $19 per 100 per year versus a credit card that was at a 12% interest rate and was costing you $12 per 100 per year. Which one should you pay off first if you're trying to do strategic debt reduction? Well, obviously it makes sense to pay off the one that's costing you the most on a monthly basis for carrying cost. So we want to throw as much energy as we can at getting rid of the 19% credit card and then rolling down to the 17, and then the 16, and then the 14, and then the 12. The only other decision that plays a factor in that is cash flow. If you have one credit card that has a minimum payment that is much, much higher, but the client is already in a deficit spending mode and they're spiraling out of control because their minimum payment on that one credit card is so outrageously high that they need to get out of debt faster, then that alters that discussion. So then, by this point, by the way, we haven't talked about a mortgage at all yet. You know, we've talked about ways to help this customer get a better plan in place financially, and that's where maybe a lot of our first-time homebuyers come in. That's where maybe a lot of our, entry-level, just fixed income, high school graduates only come in. You know, it may seem that some of the stuff that I'm talking about is a little over their head, but how much value can we create for that young couple buying their first home to help them understand that maybe it makes sense to not go to maximum ratios if they can get plenty of house at what would be a little bit more conservative. So yeah, they could afford that $1,500 a month house payment on that $190,000 or $200,000 house. But maybe the $150,000 house is all they really need for now. And that's going to meet their family's needs. So maybe helping them be a little more conservative in their purchase, and also doing it in a way that allows them the cash flow to be able to build a better financial future for themselves and their family sooner so that they can upgrade sooner. Now, steps 4, 5, and 6 is where we start getting into the more advanced customers, the customers who think they know it all, the customers who are in their mid-40s or late 30s, and they've bought 3 or 4 houses before, and they're, one of the case studies we often talk about when we work with our coaching clients is we think about the 40-somethings. The couple that's selling their 3rd home, buying their 4th home. They've got $150,000 or $200,000 in equity in the house they're selling, and they immediately want to roll that over into the new house. and take it out on a 15 or 10-year loan because they want to try and get out of debt by the time they're 50. And yet, they may have already been accelerating their equity on their previous home at the expense of saving for their kids' college or their own retirement, because they're following that conventional wisdom that is so frequently unconventionally wrong. Now, I'm not saying everybody should carry a big, long mortgage, and that's not the best solution for everybody. You know, when you do work with a couple that's in their late 50s, early 60s, and they are serious about retiring in 8 years or less, then maybe getting rid of the mortgage debt is the fastest path to getting them in position. Maybe you're working with the 40-somethings couple who has atrocious credit. They're maxed out on all their credit cards, and they've got, 640 FICOs. They can barely qualify for a home. They've got nothing for down payment, and not building equity is a dangerous situation for them because they have no financial responsibility. So there's some prerequisites to what we talk about. But a couple of the key concepts that we introduce people to are, at least we need to consider what options are available. Now, one of the key elements of this is comparing interest on a compounding environment to interest in a amortizing environment. Now, take these two different situations for just a second. If I borrow $10,000 against my mortgage, in other words, I take out let's say just for simple math, $100,000 home. I'm going to put down 10% instead of 20%, so I'm going to keep $10,000 liquid. And let's say market climbs all the way up to where we're looking at interest rates at 7.5 again. Okay, so 7.5% on a 30-year fixed mortgage is a $69 a month, $70 a month payment by the time you round up, right? The interest portion of that in the first month is $62.50. On a $10,000 investment, if I keep that $10,000 liquid and I put it in a well-structured, well-managed, medium to low-risk mutual fund that can earn long-term over a 20-year period, 6% or better net gain year over year, I would earn about $50 a month in interest on that first month investment. Now, if I looked at it in the short term, a 2 to 3 year period, that wouldn't seem to make a whole lot of sense, right? I'm spending more than I'm making. I'm spending $62 in interest to earn $50 in interest. Well, I'm upside down. That doesn't make any sense, right? But what if we look at it over the long term? See, the problem with these two things is people tend to think about amortizing and compounding interest as if they're the exact same thing, if they're thinking about it at all. A lot of people are just thinking about the top half of this line and just getting rid of that interest as much as possible so I can save a couple $1,000s in interest if I paid it off. If I made double the payment, paid it off in a third the time, I'd knock that down to about $5,000 in interest, and I'd save $10,000. But what do I lose in the process? Well, that $10,000 that yields a 6% year-over-year gain for an entire 30 years will be worth a cash value of over $60,000 at the end of that 30-year plan. Now, part of the reason for that is because think about how amortizing interest and compounding interest work differently. In an amortizing environment, I'm paying, a $69 payment, all but $6 of which is going to interest, not principal. But because I've paid $8 in principal, next month it's a couple of pennies cheaper in interest, and month 3 is a couple pennies cheaper than month 2, month 4 is a couple pennies cheaper than month 3, et cetera, et cetera, et cetera. So the reality is, if I get them thinking about this and realizing that amortizing is going to continue to decrease interest costs month over month, year over year for 360 payments, and get them to realize that it works the exact opposite of the compounding environment, whereas at the compounding environment, we grow a little bit, because that first month's interest is $50, right? But the second month they're earning on $10,050, so they're earning $52 or $53 interest. And month 3 is a little bit more than month 2 and month 1 and month 4 and so on and so forth for 360 months. And that's how we end up with $45,000 additional net worth for that family. based on that one decision. Now, when we present this idea to customers, the reality is, you know, Mr. Customer, it's not for me to make this decision for you. It's just to make sure that you're aware of how this plays out, potentially different, give you some things to think about, and then ultimately we'll make the decision as to what's in your best interest. And our coaching clients, we coach them on how to have that conversation effectively, not to offend or alienate the client, but to get them to think about and realize that they're not thinking about what they don't know. Because the reality is we don't know what we don't know until somebody cares enough to point that out to us. And if we as a mortgage professional understand this concept, what kind of moral ethical obligation do we have to point this out to people so that we help them stop making short-term decisions for what is ultimately a long-term situation? You know, then in the consultation, we're still in the educate phase of the consultation, then we can talk a little bit about, you know, what is equity? You know, the other myth that people tend to make, or the misconception that people tend to make decisions under, is they start thinking about equity as if it's a bank account. Well, here's the problem. It would be a pretty crummy bank account, because what is the only way you can get equity back, right? You got to liquidate the asset, which is the property. So the first question is, does equity really even exist? If not, is equity an asset? And this is, again, a carefully crafted conversation that we've got to work with and get customers to realize at the end of the day, you know, here's the thing. It's not the property that gains a rate of return. It's not the equity, it's the property. The equity is just the paper calculation between the approximate value of the home and the mortgage that's secured against it. So take a look at these two neighbors for just a second. Same house, same block, same builder, same square footage, same floor plan, identical neighborhood. Two buyers buy property in the same neighborhood. Let's say it's new construction. One buyer pays cash for the house, has $250,000 in equity. The other guy does a more conservative, more traditional strategy of putting just $50,000 down and carrying a $200,000 mortgage. Over a 5-year period, those properties appreciate. They gain $50,000 in value, so all of a sudden those properties are now worth $300,000. So neighbor A has gained $50,000 in value on his $250,000 initial purchase. So his equity has grown over a 5-year period by 25%. Now, the same customer over here who put $50,000 in equity down gained $50,000 in property value. The house is worth $300,000. Now his equity has grown to $100,000, and he's experienced a 200% gain on his $50,000 equity. In other words, he's got 5-to-1 leverage. Now, he did have the carrying cost of the mortgage, but if you subtracted out the net carrying cost, you'd still be plus money ROI if you did the calculation. The reason we do this illustration, by the way, is not really to sell the idea that they need to carry a bigger, longer mortgage. It's to get customers to understand that equity isn't the asset. The home is the asset. They grew at the same time, and they lost at the same time if they've lost value. So the overall value of it is getting them to consider what they can do and how they can gain and grow and what that looks like for them long term. So one of the other tools that we get into then is, once we've educated them on a couple of these simple concepts, then it's time to go out and talk to them about what's right for them. Because at the end of the day, it is ultimately their decision. So then we start getting into, how do we do comparisons? And this is where we use tools like Borrow Smart analysis. And the folks at Mortgage Success Source who sponsored this program were kind enough to share with us some resource materials, and Todd Ballinger has been on this webinar series before, and in the interest of time, we're not going to go very deep into some of this stuff. But here's a tool that you can use to help educate your clients on what's right for them. And we can start creating some presentation tools. So like, for example, let's go back to that basic situation. Let's say we're looking at, let's say, a $250,000 purchase. If we're comparing a 15-year mortgage at 80% LTV versus a 30-year fixed mortgage at 80% versus a 30-year at 90%, leveraging single premium MI for borrowers who have great credit. Now, assuming the same mortgage payment roughly is going to be paid, the highest of the payments required would be this one. You can do side-by-side comparisons and determine what's ultimately in the best interest for that client. See, this 90% option, they'd be keeping $23,000 additional liquid to keep invested, plus more payments would be going as a monthly contribution to a savings, which means their net worth ends up being higher when you do equity minus payments. The final bottom line net worth over a 20-year period in this scenario would end up being this option C, this 90% LTV single premium MI loan, would end up benefiting the customer over $100,000 more positive net worth over a 20-year period. Now, the other elements of some of these conversations and discussions are, as we look at the structured payment, we do side-by-side comparisons, we can now get into the nitty-gritty. Now, some of this can be done with a pencil and paper. Some of it can be done with some of the simple calculators so that we can get the right kind of discussions going, getting the clients to think about the options and what's in the best interest for them. Now, the third level of this discussion, after we've presented the ideas and we've helped them make some decisions on what's ultimately in their best interest, and by the way, one of the other things that I do when I do these presentations with clients directly, I like using the Borrow Smart calculators, some very, very simple calculators. One of my favorite, which I actually didn't show you a screenshot of here, I thought I did, is this simple savings calculator. I can literally plug in, in 10 seconds, 23,000 liquid, 200 and something month installment investment, a 4% rate of return on that savings account. What does that turn into in 20 or 30 years? And we can do all kinds of kind of shoot from the hip comparisons with clients very, very quickly and very easily, that we can get information in front of them. And that's where that third phase of the conversation comes in, which is once we've laid out a couple of different options and we've gotten them to consider the pros and cons of, do we want that extra $107,000 net worth? Do you have the financial stability? And by the way, there's two prerequisites to taking a more aggressive approach to equity management and focusing on leveraging the equity in the property longer. One is they've got to have the income to support the higher debt, because they will be likely carrying a higher debt cost. Two is they've got to have the financial responsibility to stay that course long term, that they're not going to freak out and decide that they want to go buy a boat or something like that when the account hits $100,000. But once we've gotten through the first phase, which is the education phase, is just simple concepts and ideas that need to be considered and really should be thought about when making mortgage decisions. Because the reality is we can't afford to apply short-term thinking and conventional wisdom to what is an unconventional process in today's environment, and what is ultimately a long-term decision has long-term impact for the client. Then we've talked about different loan options, and we've gone a little bit more into detail on how to compare and contrast some of those options. Now we've got to engage the client. And this is to the question that was posted in the Q&A that I've been trying to monitor a little bit as I'm speaking here, some of the lost opportunities. You present all these ideas, you've spent a lot of time talking to clients, you've given them all these great ideas, and they're still running down the street and doing that loan with somebody else who's undercutting us by a small margin. How do you deal with that? Well, that's where we get into the last part of our conversation, which is we start talking about how to engage clients. Now, one other tool that does this is by using the mortgage market guide charting as part of our consultation. We talk about the ebbs and flows in the market. We talk about where the peaks and valleys are. We compare the long-term trending, and we talk about, at the end of the day, if I looked at a chart like what you see on your screen right now and I was talking to a new buyer, we tried to test the ceiling of resistance here. All the moving averages are against us. Likelihood is, Mr. Customers, I would be a betting man and go with the safe bet of more of the insurance policy approach here. Could rates improve? Yeah, they certainly could. but I think we got an 8-to-1 odds on probably not improving, continuing to deteriorate if we're seeing this kind of a downtrend and we're at the top of the trading range over the last couple of days. So I would probably be saying, look, Mr. Customer, at the end of the day, it's like buying an insurance policy. You spend $1,000 a year for an auto policy for 10 years and don't have a wreck. You might be a little upset you spent 10 grand. Flip side is the 11th year you have that wreck that causes $20,000 in damage to your car and $30,000 to somebody else's. In other words, a $50,000 total expense. You're pretty happy you spent $10,000 to have that $50,000 expense covered by the insurance company, right? So do you want to trust me to lock the loan? Do we want to go ahead and get this off the table and get you the best possible pricing? Or do you want to trust me to float it? Or do you want to gamble it? By the way, some of this has an impact on what your company's renegotiate policy are, and we're a huge advocate with any of our coaching clients that you need to know what your lender's rate renegotiate policies are in case the market does get unexpectedly and dramatically better. Do you have an option to break out the previous lock and reprice in a more favorable term for the buyer? Not necessarily for your own personal benefit, but for the buyer. Can you help the buyer take advantage of a drastically improved market if it does happen? And in some cases, in a highly volatile market, that's a decision that that many loan originators and many of our coaching clients make decisions on where to place their loans based on favorable renegotiate policies that are consumer benefit oriented. So part of the discussion then we get into about how to engage and how to secure clients and not lose them to somebody else who's just undercutting us by a thin margin is by focusing on the clarifying your value conversation. So there's really 4 key parts to that conversation. The first one is how banks make money, a rate versus fees discussions. Practical reality is, Mr. Customer, at the end of the day, rate and fee are married. You can't separate the two. So let's take a look at some rate sheets really quickly. And in any given day on a conventional loan, I can show you rates that go across a 0.5% range. And I can give you a lower rate and charge you money up front to cover all the overhead and closing costs, or I can give you a higher rate where the end investor for that loan covers those overhead costs. The point is, rate and fee are married. We can't separate the two concepts. So whether you're with a peer broker and that has to be disclosed, or whether you're with a bank, we all get our money from basically the same 3 sources, Fannie, Freddie, and Ginnie. The only variances from one lender to the next is whether they give you the opportunity to do what's best for you. Because the longer you hold that loan, the more likely it makes sense to do the fee if you have the cash to do it and get the lower interest rate versus doing the rate and letting the investor pay for it, because you're going to be paying that investor back every month over the entire duration of that loan. So that's one of the first comparisons. The second comparison in that clarifying your value conversation is talking about specific cash benefits of the structure that's being offered. So we talk about the 6 steps to financial independence. We go to a comparison chart and we talk to them about what it looks like 12, 15 years down the road and how much we've helped them increase their savings balance because we've suggested a strategy that keeps $30,000 cash liquid up front and $150 a month that goes into a structured investment account that's earning a long-term growth rate of 7% or better. Well, at the end of the day, Mr. Customer, we're looking at a strategy that's going to put an extra $86,000 in your savings account with a net worth increase of over $38,000. So that's where we start to engage the client and confirm their intent to proceed because we've dollarized the value of the strategies we're suggesting and the long-term advice or guidance. So that key closing question becomes, at the end of the day, Mr. Customer, the strategies and advice and guidance that we've given you, you could certainly go down the street somewhere else, and I guarantee you'll be able to find somebody who would do this loan a couple hundred, maybe even a couple $1,000 cheaper for you. But at the end of the day, is it worth $1,000 on any one transaction to get the kind of advice and guidance that's going to turn into $86,000 increased net worth over 20 years? Now think about what that question does. When the buyer says, no, it's not worth it, yes, I'm going to move forward in the loan with you. Now that's a strong question. But the reason it's strong is for their benefit as much as our own. If there really are going to be the 1 out of 10 guys who's just an obnoxious, hardcore price shopper jerk of a customer, when do I want to find out? Within the first couple of hours I've spent with the guy, or after he's dragged me through the ringer for an entire 45-day process, beating me up every step of the way? Would I rather let that customer go up front and let him be somebody else's problem? And how many more loans could I write by working with customers who understand and appreciate the value that we're offering and can benefit from it substantially over the course of their lives? See, that's where we can create a game-changing first impression with clients. It could be a life-changing experience for customers. So in the interest of time, I'm going to move through today's webinar, and actually I'm powering through a couple of things really quickly. By the way, keep posting your questions in. I will make sure our coaching team gets followed up. There's been some great questions come through here. If you'd like more information, by the way, about the Borrow Smart analysis program or the Borrow Smart tool for Mortgage Success Source, let me give you these contact bits of information very, very quickly. If you're an individual mortgage loan officer and you're looking for contact, call Scott Remett. His extension is 1579, or you can email him at sremete@mssllc.com. You actually can change this to vantageproduction.com as well. MSS recently changed their name to Vantage Production. If you guys haven't seen that, notice. I was intending to try and get an updated slide from them, and they were not able to get it to me in time for today's program. But anyway, the email address is sremete if you're an individual MLO. If you're looking for more of a corporate account structure, Mark Tateris is the primary contact. His extension is 1573. Both of them can be reached at the same toll-free number. And, of course, Mark's email address, mtateris, T-E-T-E-R-I-S, at mssllc.com. Now, in the interest of time, I'm going to push through a couple of things here really quickly. I was going to talk to you a little bit about how we can, in the interest of trying to make sure we have plenty of time to cover the content, we'll have to put a future session together for you to go over some of the things that we could also do at the end of the consultation to have a big impact on getting more referrals. But since we're getting close to the end of our time here, there's one last thing that I need to share with you guys, and that is how do you make sure that you implement or execute on these ideas? So as we start thinking about every time we try a new concept or a new idea or a new script or conversation outline, like some of the great things that you've heard me share today about, the best rate in the world on the wrong program will likely cost you a lot more than the right program at a competitive price. Every time you try one of those things, you want to make sure you're learning from experience. The second thing I want you to think about is what actually creates implementation and action. Now think about these guys for just a second. What do they all have in common? The Michael Jordans, the Wayne Gretzky's, the Tom Brady's of the world. They're all top performers, right? They all had somebody who cared as much about their own success, if not more so, that they held their feet to the fire. They helped them push through the challenges and difficulties of their career growth. They held them accountable. At the end of the day, what does an accountability partner provide you? Well, an accountability provider is somebody who, one, you trust enough to take their advice seriously. They have credible knowledge about what you want to accomplish. They can tell you what the best of the best do. Secondly, they can give you that outside perspective. You guys have all heard the cliche about the forest for the trees, right? Sometimes we get so busy being busy, we stop to reflect on using the right tool. Like think about, imagine you got two ways to chop down a tree, an axe or a chainsaw. If you don't know that there's a chainsaw out there, how do you know? Wouldn't it be great if somebody could bring one by while you're trying to whack at a tree with an axe and hand you a chainsaw? Well, that's kind of one thing that an accountability partner can do for you. Thirdly is they can keep you focused on steady progress and hold you accountable and be kind of that running buddy who, even though you don't maybe necessarily feel like it, you feel guilty if you don't do it, so you get up and do it anyway. In 1989, Brigham Young University did a research study about implementation, and what they realized is when somebody says, hey, that's a great idea, you're going to have about 10% chance of implementing on that idea. When a person says when they're going to take action and they commit to doing a specific task, they've got about a 40% chance. When you tell somebody else what you're going to do and you verbalize it to the potential accountability partner, you get a 60% chance of executing that idea. But when you set a specific future time to share that progress with somebody else, you got a 95% chance of follow through. So you want to find a partner you can work with. You want to drill down on how to become an effective accountability partner. And that's what we do with Maximum Acceleration. You know, at the end of the day, we provide a structured program developed through hundreds of hours and thousands of hours worth of research and development work. Over 2,500 clients have gone through our program since we launched in 2006. The kind of results that we see our clients achieve is a strategic growth. And you can read some of the testimonials on the screen. For example, Mr. Randall Bauer doubled his income 2 years in a row consecutively. Year to date so far this year, in 5 months, made more than he made all last year, and is on track to make over $800,000 this year in gross branch revenue for his branch. So was his coaching investment worth it? Well, if you're serious about taking your business to the next level, you're looking at about a $1,000 a month investment with our coaching program. If you'd like more information and you're ready to take your business to the next level and you're willing to invest in your own personal growth and development with the kind of strategies and guidance that will get you long-term change, we'd be happy for you to take advantage of one of our opportunities to talk about it with one of our coaches, get a coaching experience through one of our strategy sessions, and make the commitment to take your business to the next level. Anybody who's interested in taking advantage of coaching as a result of today's webinar, you can knock another $500 off that coaching investment. And we'll be happy to get you started on that plan. In the interest of time, guys, just one last thing that I want to share with you, in addition to some of the bonus tools and materials and resources that you get to take advantage of. The last thing that I want to share with all of you is if you want to go ahead and take your business to the next level, you're welcome to take advantage of our strategy sessions, which is where you get together one-on-one with a coach, get a consultation about where you are and where you want to go with your business, talk about the coaching investment, whether it's the right time for you or not. If not, when not, find out if you're a good applicant or a good potential client for our system and whether you'll benefit or not. Now, the last thing I want you to do is think about some upcoming opportunities. If you've liked today's program and you'd like more of the same, next series in the this Go to Maximum Performance webinar series is Coach Stephanie York on Tuesday, July 9th. We are going to skip the holiday week of next week. So next Tuesday, July 9th, will be the next installment in this series. Coach Stephanie York will be back with us Tuesday at 11 o'clock sharing leadership versus management, how to build a business that lasts. Recently, Stephanie did an extensive research project and completed a master's in organizational leadership. And I'll be sharing some of what she learned through that program. And as she finished her research project, some of the findings from that research study. And that you can sign up and register for that event, mxlcoach.com/webinars. In addition to that, the last thing is you've invested an hour of your time today to hear about today's program and to get some of the advice and guidance that we've shared with you today. Hopefully you found it beneficial, but think about it from this perspective. Do ideas without action have any value? I mean, I don't care how great an idea is, does it have any value to you and the growth of your business if you don't execute on that idea? Well, the obvious answer is no. So I want you to take one last step here. You've already invested this much of your time. Why not invest 5 minutes more? So before you pick up the next phone call or before you jump into your email inbox and look at the 15 or 20 or 50 emails that have come through in the last hour, take 5 minutes and decide what your action plan is going to be with the information you've absorbed today. Pick one thing, one most valuable idea that you want to execute that you heard in this program. What was it? Make the decision right now. Second, decide what action do you need to take to make that a part of your daily business going forward. What's the specific step? Maybe it's go back to that section of the tape and jot down the bullet points of that clarifying your value conversation. Maybe it's thinking about signing up for a free trial of the BorrowSmart analysis and going through some of their tutorial videos and figuring out how you could use that as a tool to illustrate the value of some of the advice and guidance that you would like to give your clients. Recognizing and being committed enough to helping your clients and caring enough about their success, but even when it's uncomfortable, that you share with them the ideas that they're not thinking about when they're making such a critical decision in their mortgage process. Whatever that action item is, make a decision. What do you need to do to make this one idea work in your business? Third is by when. Set a target date. When would you like to have that action implemented? What's your target ideal completion that you want to shoot for? And thirdly, decide who are you going to ask to hold you accountable. You know, pick somebody that you trust and respect enough. Tell them what you're going to do with following through on this action plan. Somebody that, you know, if you didn't follow through on it, you'd feel kind of like a jerk. You'd feel a little bit guilty. And tell them to follow up with you on a specific deadline. If you need help finding an accountability partner, if you'd like to talk to one of the Maximum Acceleration coaches, of course, you're welcome to take advantage of the strategy session opportunity. www.mxlcoach.com/strategy. We'll schedule a one-on-one appointment with one of our coaches. They'll talk you through a little bit about what the commitments look like and whether it makes sense for you guys to move forward or not. Like I said, our first goal is getting the coaching program to where you're getting at least a 2.5 to 3 times return on your coaching investment. For most loan officers with commissions in the range of $12,000 to $2,000 or a little more per loan. For most clients, it's 1 to 2 additional loans a month is going to yield you a 2.5, 3 times return on your monthly coaching investment. That's our first and foremost goal. We hit that goal about 85% or better of the time. So if you really are serious about taking your business to the next level, then consider the opportunity to invest in your future for the long term and take advantage of the opportunities to grow your business. Of course, if there's anything myself or the rest of the team can do for you to help you continue to grow your business and continue to accelerate towards the goals that you want, to adapt and adjust to the changing, shifting market and how to get more purchase business going in your business, and getting the help, guidance, and support that you need to make that happen in the minimum amount of time, and you're willing to invest in yourself just like you would any other educational process, college or otherwise, then we would love to have the opportunity to talk with you further about that. Otherwise, we hope you've enjoyed today's program. We hope you've gotten some value out of this. Just to let you all know, there will be follow-up material coming, usually within about 2 days. Keep in mind, be patient with us because it does take a little bit of time to do the post-production video editing work and rendering it into a format that can replay in a streaming environment like YouTube. So as soon as we can get that work done, usually we get that done by the end of the 2nd day. So by midday Thursday at the latest, you should receive automatically an email that will have a copy of the PowerPoint from today's program, as well as the video recording link from today's session, and maybe a surprise bonus material or 2. Of course, if there's anything myself or the rest of the coaching team here at Maximum Acceleration can do for you, please don't hesitate to reach out to us and ask. Otherwise, I want to wish you all the greatest success in the implementation of what we've learned today, and I look forward to seeing all of you on